evening, everyone. Senthil here. Is my audio and video clear? Can everyone see my screen and hear my voice clearly? Good evening. Is my audio and video clear? Let me also check my infrastructure. Okay, it is working good. So let's start with the last session. So of course, on Monday we'll be having a money management and client profiling session. So let's start the today's session. Derivative strategy 3. Derivative strategy 3. So today we are going to learn about CR credit spread back. I'm sorry, call ratio spread back and put ratio spread back. So these are the two strategies we are going to learn. So the benefit of this strategy is unlimited profit and limited risk. Unlimited profit and limited risk. So let's start. So call ratio spread back. So the name itself is very clear. So it is going to be on a call option. It is going to be on a call option and it is going to be on a upper side, bullish side, bullish side. So let's learn. Disclaimer. So option strategy, call ratio, back spread. Options are known for unlimited loss and profit when it is open or uncovered. How to trade in stock or index option with limited loss and limited profit. So profit will be unlimited here and loss will be limited. So the process involves three-leg strategy, three-leg option strategy. So far what we learned in the previous things, all those things are 1 plus 1, that is two-leg option strategy. So here it is three-leg option strategy, buying 2-lot OTM call, buying 2-lot OTM call and selling 1-lot ATM call option in the same expiry. This is 2:1 strategy. Any doubt? Any doubt? So it will be three-leg strategy and buying 2-lot OTM call. So the previous strategy, whatever we learned, we will buy 1-lot ATM and we will sell 1-lot OTM in the third strike or fourth strike, maybe third strike. So here we'll be selling 1-lot ATM call and we'll be buying 2-lot OTM call. Both are in the call option only. Direction, bullish trend is expected for a profitable trade within 3 to 5 days. Again, holding period, there is a restriction. If you buy and if you forget, it will be ending up with the predefined loss. Again, it will be huge only. So goal, to profit from bullish movement. To profit from bullish movement. Maximum risk is predefined. So we'll learn with the examples. So maximum profit, potential profit is unlimited in upside movement. Potential profit is unlimited in upside movement. So choosing the strike price. So it's a three-leg option strategy, 2:1 proportion. Buy 2-lot OTM call. First we should buy 2-lot OTM call. Then only we should sell 1-lot ATM call to get the margin benefit. It should not be deep ITM. It can be just ITM. It can be just ITM. If the market price is 451, we can sell 450 call option. We cannot sell 455 or I'm sorry 445 or we cannot sell 440 call option. Right? Any doubt? So when you implement this strategy, the strike price is very, very important. And if you take the positions when the strike price, when the current market price is around the strike price, we will get the maximum benefit. Ensure both call options are in the same expiry and the stock. If you are taking Reliance April month contract, all three legs should be in April Reliance contract only. It should not be in other month contracts. Ratio should be followed. Any changes in the ratios will violate the strategy. So you can see here we are selling 1-lot 2300 call. Let's assume the current market price is 2297. We are selling 1-lot 2300 call, buying 2340 call option, buying 2 lots 2340 call option. So worked example, Reliance current market price of the future is 2305. I'm expecting the stock to give 3 to 5% bullish movement in 3 days time duration. Set off your target. Stock should reach 2365 to 2375. So these two are very, very important. Any doubts, sir, madam? Whenever you trade in derivatives, time, range, that is the target, and momentum, both all three are very important. Without this, you cannot touch derivatives. Can I get one line of yes from everyone? Can I get one line of yes from everyone? The duration, when you trade in derivatives, the target, next is range, next is momentum. So these three are very, very important. And again, of course, stop loss. So without these things, we cannot trade in derivatives at all. Now buy 2 lot 2340 call option, 2 lot 2340 call option, that is OTM around 26. So we are buying 26 into 2. So our outflow of the money will be how much? 52 rupees. Outflow of the money will be 52 rupees, and sell 1 lot 2300 call option around 44. So premium reserved received by selling is 44 rupees. This is inflow of money. Premium bought by buying two options is 52 rupees. That is 26 into 2. That is outflow of the money. Difference is 44 minus 52. At any point of time, your loss cannot exceed more than this 8 points. Are we clear? So we are defining our predefined risk. So let's see what is the investment required. So investment required is when you go by this proportion to initiate the trade, you require 37,000 rupees. And once the position is initiated, you require 26,000 rupees to hold the proportion. So it may change plus 5,000 or minus 5,000 depending on the expiry days left for the market. So maximum loss is 12,500 and maximum profit is unlimited. So there is something, we'll check it. When we go with the live example, we will see that. So now investment required is 50,000 including money management. Case 1, maximum profit. Reliance moving 2 to 3% upside around your target within 2 to 3 days. So you can see here within 2 to 3 days, Reliance moving 3%. So the sold call option will give you loss. The bought call option will give you profit. Adjusting both these things, we will get a profit around 4 to 5,000 rupees. Next. Reliance moving 4 to 8% around your target. So we are getting an exceptional movement. So whenever you have a news in that particular stock along with the analysis, so we can enable this strategy to predefine our risk so that all the options does not become zero. So stock is giving movement 6%. Now here we will go with the example. So I have taken complete till the expiry. See, now when the stock is completely away from our zone, our danger zone will be we are buying here till here or here only. We will be scared to hold the position. If it is crossing to the next level, yes, we can hold. If it is in very good profit. So you can see here again it will give you loss, it will give you profit. End of the expiry, it will be 11,000 rupees. So we'll optimize and see that also. Profit is limited, profit is unlimited. So still do not hold the position till the expiry. Risk is associated with the strike levels. One crash in the market, sold options will again come back to life, or the call option will go back to the premium whatever we bought. So let's see that with the example. So let's take Reliance. So do this in high liquidity stocks. That is very important. Reliance cash market is 2934. So let's see the future price 2940. So it is in perfect level. So I am selling 1 lot call option, buying 2 lot call option, buying 2 lot call option OTM. So when you do this, please do the instruments, please do with the instruments so that we can arrive the maximum risk before we enter the trade itself. This is very, very important. Use any option tool. You can use Sensible completely free, and I don't use Opstra Like that, many are there. You can use whichever you are comfortable, or your regular or routine platform, you can use it. So now, if you see here, the capital required is 30,000 rupees, 31,000 rupees. The maximum loss is 15,000, which means 50% maximum loss. So we will not wait till that much. So because we will be always exiting the position with a predefined loss, which is 1.5%. Is this good? Even when we take this position with a maximum loss of 50% on the premium value, when market comes down, what happens if the market is against my position also? Whatever I lose in the call option, I make profit in the call option which I sold. So my ultimate loss will be very minor. That too after 3 days. So you can see here, if it is in the same day, okay. So after 3 days, 4 days, now we are taking Friday, Saturday, Sunday, Monday. So that is the reason it is taking 1248 rupees, or else it will be stop loss should be on the spot levels 1 to 1.5%. Stop loss should be on the spot level 1 to 1.5%. We should not keep a stop loss on the leg wise. Okay. So now, if you want to minimize the risk, let's optimize and see. Let me take 2980 call option, 2980 call option with 1.5% stop loss. What is happening? My premium is eroding fast since I am buying nearby strike, my loss is increasing. So we will go with the third strike itself. Whatever you are selling from there, we have to go with third strike. Any doubts, sir, madam? ATM sell, from here third strike buy, 1 lot, 2 lot. Any doubts? So it's a very simple formula. You have to make a note in the bit of paper, and before you execute the position, you should do this. So you can see here, current market price of the future is 2940. Okay, so I am taking 2940 sell, ATM call option sell when I am in the bullish trend. At the same time, I am buying 2 lot OTM call option to make profit. So now let's see, in 3 days, if the stock is giving 3% movement upside, I get a profit of 6,000 rupees. Any doubt? Because this 3,000 call becomes ITM, even let's take even 2%. So this 3,000 call moving forward, you can see it is giving 12,000 rupees profit, and the sold option giving 8,570 loss. So we are getting a very decent profit. You cannot hold till the expiry. I will show you that also what will happen. Okay. So now you can see here 6,155 if it is 3%. If it is giving exponential movement 4-5%, you make very big profit because the profit is unlimited here. Now let's say stock is giving only 3% movement, 2 to 3% movement, but days are going. What will happen? The sold option, see, we have sold 2940 call option, and we have bought 3,000 call option. Both will start depreciating, and when the days goes, it will start giving us loss. Are we clear? The disadvantage, if the stock is not moving, at the same time, if the stock is giving a movement of 6%, this will become adjusted to the IB level. 30,000 will be the loss because stock is moving upside, so it will give you loss. And this stock also, this OTM option which we picked, that also become ITM. So we'll end up with a decent profit, but the risk level is in between 2 to 3%. Or see, now stock is going against us, but still we are not making loss. Can someone tell why? Because you can see here, we sold an option for 47,000 rupees, and when the price becomes OTM, right? When the price becomes OTM, so this profit will cover this loss, and end of the day we will end up with minor loss if you are holding till the end of expiry. But let's conclude this as it is not an expiry trade. Are we clear? It is not a setup for holding till the expiry. So two things only we will see. One, 3 days holding period. 3 days holding period, stock should give 2 to 3% upside. Any doubt in this? First point of understanding. If it is moving upside, days are going, you can hold. If it is moving upside, days are going, you can hold. But further, if the stock stops with 5% and if days are going, it will start giving you loss because of the premium erosion. Any doubts, sir, madam? Right. Next, number 2. We are taking the position today. Today itself, stop loss is hitting. We have to exit the trade. Are we clear? Any doubts? Can we manage this small stop loss? It is looking better than any other open position, right? Am I right or not, sir? This strategy looks very much better than any open or naked call option or put option, right? The only thing is I have a disadvantage of making small profit, but that is fine. The problem will when we trade in option is the moment you buy for 10 rupees option, suddenly slips and comes to for 6 rupees. After that, minus 1 day, it opens as 4. It opens as 4 rupees again. After that, our mind does not accept to close the position, so it becomes invalid or it becomes 0. So to avoid those things, you go as per technicals. You keep a stop loss. When the stop loss hits, you exit with a minor loss. Any doubt? The same thing you can do with any other stock also, but the maximum loss levels will be high. The premium, the margin required also will be high. So let's take ICICI Bank. Future 1106. So now I have to sell 1100 call option 1, 2, 3. Buy 2 lots. So you should keep a step. Wherever you sell, leave that 1, 2, 3, enter buy. So the maximum risk you can see here, it is 17,000 and capital required is 31,000. I am in a long position. Since we are taking, since we are selling a call option, it does not mean that even if it is going down, we will make profit. No, I am very clearly in a long position. Right, capital required is only 31,000 rupees, including money management. You require 50,000 rupees in case two trades are going loss. So to manage that uneven things, so we need capital more. So stock is moving upside 2% or 3% in 3 days. Take profit 1,500, 1,600. Why here it is not matching? Because the profit is not good, because you can see here the spot is in uneven level. I'm sorry, the future is in uneven level 1106. So the best practice to make an entry here is 1110 or 1120. So when you enter the positions when future are at round level, you make this profit will become 3,000 rupees. Right. So let's see here. Now, if it is going against me, if the position is going against me, still we make some profit because the sold premium was higher prices, higher range. So it is in that way. So let's see some other stock where the future is at round level. 769. Yes, we can take this. We can consider as 770. I am selling 770 call option. Step 1, 2, 3, 4. So from here 1, 2, 3. I am buying 2 lot call option. Right. So loss here, it will be like little alarming. 30,000 rupees. I'm sorry, 23,000 rupees. But we are never bothered about this because our lifespan of this trade is only 3 days if it is in flat market. If it is in upside market, we can hold up to 5 to 6 days. Any doubt in this, sir, madam? Any doubt in this? You should not forget this. Simply if you buy and hold it for n number of days, loss is guaranteed because of the theta decay. So now you can see here stock is going down 1.5%. We make a small loss 1766 and stock is going towards my favorable direction. I make even after 3 days, I make 6,000 rupees. Right? Okay, after 3 days, what is the loss? Okay, 1.5%, 3 days, 3,000 rupees. Because here the premium is costly, right? Premium is in the higher prices because of the lot size. We can try this with HCL or Infi. You can try with TCS. So we have to pick the stocks where the lot size of the particular stock is around less 250, 300, 500, 750 maximum so that the risk will be very less. So Infi, let's see 1488, okay, accepted. Let us sell. Okay, so we are trapped in this in between. So now whatever you pick, you sell 1480 or 1500, both will not adjust with the profit and loss. Let's take 1500, 1, 2, 3, 4. So loss is 22,980 maximum loss. As I told you, we don't have to bother about that because it is a maximum loss. If you simply hold the position till the end of the month, and if the stock is going against us, that is in between range, then we will take the maximum loss. 3% upside. I told you, right? It will not get adjusted. So let's take the profit is coming very less. So let's see, stock is going down. 3 days loss is 1600. So now the best practice I'll say, before you enter the position itself, you can optimize and see. Before you enter the position itself, you can optimize and see. Let's take Infi chart. So now you can see here there is a potential upside. If it is moving upside, there is a potential upside. So 1.4 we can take a target of till the expiry, we can take a target of 1560. Okay, so let's reset this. So still the profit is very less. Okay, margin required is 24,000. I don't know why there is some mistake. I think, give me a minute. Proportions are right. Margin required is 25,000. Maximum loss is 23,000. How come it will happen? So let's clear. Add it again. 1484. Okay, let's take sell one lot and buy 1, 2, 3. So capital required is 24,000. Maximum loss is 23,000. Somewhere it is not adjusting. 3% after 3 days. So we can better avoid this strategy in this particular stock because premiums are not properly evaluated. Somewhere it is like call options premiums are very cheaper. So let's review that also. Let's review that also, why it is like that. So if you see here, okay, 1484, okay, 3830. So everything is right, but somewhere it is not working. So this strategy we have to avoid in this particular stock. Let's take one more stock, TCS. Can we sell OTM? No, that is different strategy. Sir, as I told you, so here in covered options, you can do whatever you want, but the only thing is when you optimize and see, it should work. 4016. So let's take 4020 sell. and the third strike buy 2 lots. Capital required is 35,000. 3% movement, we get 7522. Maximum loss is 16,000. 1.5% loss after 3 days. It will be 3,223. See now, when you make loss, I don't think you require 3 days time. Am I right or not? Because if stop loss is going to hit, it will hit in the same day itself. Most of the times, whatever I have seen, it does not wait for 3 days and hit the stop loss. When stop loss hits, it hits in the same day itself. So we can save that theta decay when stop loss is hitting. Right. In fee is the proportions are not matching in fee. In fee, everything is looking right, but the proportions are not matching because the future price is in between 1488. So we don't have a strike price at 1490, right? So we are picking 1480 or 1500 for sell, and from here we are taking 3 strikes for buy 2 lots. Right. So this proportion is not matching. So the best time to execute the trade is 1480. When the future is reaching 1480, you can sell the strike plus 3 strikes later buy, or when it is reaching 1500, you can do this activity. Any doubt? So let's complete the PPT and we'll see the balance things. We have seen all those possibilities. 1, 2, 3 we have seen. Okay. So call ratio back spread. Cautionary advice: traders should remember that as long as they are in short a call option, they should not sell their call option which is bought if they don't want exposed to unlimited risk. Naked short or naked short a call will have unlimited risk. Also remember, the order of buying call and selling call should be traded immediately within minutes. You have to buy a call option first, then sell the call option, then only we'll get a margin benefit. Always have analysis for the entry stop loss with entry stop loss to maximize the risk and take advantage of the strategy. Before you make an entry, you optimize and see what will be your loss, what will be your profit, then you enter the trade. This is not an expiry trade to hold at the end of the month, till the end of the month. Spot price, no. See, when future and option, when we do a combination with future and option, right? Option will move as per the future. Number one. Say like for example, let's say spot price is 380. Okay. And the future price is 400. Now 400 call, this we tell us ATM, or 380 call we tell us ATM. Can someone tell one or two? Maybe it's a new information I am giving. Which we will tell us ATM. This only called as ATM. This is not. Are we clear? Both are underlying of the spot, but option moves as per the movement of the future. Option moves as per the movement of the future. So 380 is not ATM, 400 only will be ATM. Right? Next, best stocks to trade. The stock should not be under factors of earning. That means stock should not move like this. It can either come down and hit your stop loss, that is fine. It can go up and hit your target. Of course, every time when we say go up, it will not go up like this. It should go at least like this. So it should hit the target. It should not go sidewise. Best time to trade is to initiate the strategy whenever the risk and reward is at least 1:1.5 levels. That means we should have a minimum target of 3% in 3 days time duration. Then only Any option strategy we can implement. Again and again, I'm insisting. If you don't have a 3% strategy target level in the next 3 days, do not trade in derivatives, not in future, not in options. Are we clear, sir, madam? Anyone who is expecting only 5 points, 3 points, 2 points movement or half a percent movement, I can trade in option. No, definitely you are going to make loss only because half a percent option will depreciate only, right? That is, I'll give you a small example. Let's say if you are buying 500 when the price is at 500, right? We are buying 500 call at 10 rupees. Price will go to 503 and again it will trade in between 497 for 30 minutes. This option will become 8 rupees 70 paisa. Are we clear? Any doubt? Worst case it will become 9 rupees just for 30 minutes. This is the time value. I'm telling on an approximate figure. If future or cash market is giving a consolidation, option will keep on depreciating. Option will keep on depreciating. Right? Again, if the end of the day, if it is closing at 505, this will come back only to 10.5 only. It will not give you big profit. So always remember we should get with the good volume when we get into options. When you trade in options, we should get into good volume. So how to identify volume? Okay, I'll give you a simple trick to identify a volume. So now you can open any trading terminal. You can open any trading terminal, but the vendor should provide you something called as volume chart. It is a volume candle. Everyone knows this, right? Normal candle, everyone knows. Now, if you come down, there is something called as volume candle. Okay, so the color will come like this. Just a minute, I'll show you. Click here, come and see here. It will be like volume candle. Now, let us take Nifty itself. So market was downtrend. Market was downtrend from 22,700. It started coming down. Let's take 22,600 put option. Can we see the difference between these candles and this candle, sir, madam? This is called as momentum. Are we clear? Any doubts, sir, madam? Can everyone see the difference? When you see a normal candle, you will not feel anything, right? When you see a normal candle, you will not see anything. But at the same time, when you see a volume candle, and when you see the before you buy an option, when you see the candles are very tiny, small, it's trading like this, like this. Do not enter in that particular trade. It is a valid point for rejection. Are we clear? Any doubts? That means when you decide to buy, I'll give you a small example. When you decide to buy, let's say like if the last 10 candles is candle width. See now what is the main difference we see here is the height of the candle, everything will be same between normal candle and volume candle. Now, whenever there is a volume, what will happen is this particular candle will become fat. Everyone knows what is fat, right? Everyone knows, right? So it will become fat. So I'm shifting this to volume candle. Can you see this? Very less movements. It's not fat, not fat, not fat, not fat. Suddenly it is becoming fat. So this fattiness will come only by here, not by here. This fattiness will come only by here. Yes, that is the right place to make an entry. Right. Morning, someone was seeing Tata Motors. Do we see the difference? Just a minute. What was the D? 920, right? So even if you plan to buy this particular stock option, when you see candles like this, do not buy. Are we clear? Any doubt? Any doubt? It's an additional point. Do not ignore your technicals. If your technical says right, yes, but without volume or without buyers, will option go up? It will not go up, right? So whenever you see, at least when you see this type of candles, the next candle should be at least it should become like this. Then only it will move. So you want to compare side by side. Just a minute, I'll do it. Clear? What happen if huge selling is there? Selling is there also flat pad. See, whenever selling is there, what will happen? See, this place selling is happening, right? This place selling is happening. Let's see. Stock started falling from, let's see the time. Give me a minute. Around 12 o'clock. When Nifty started falling, stock also started falling. 12 o'clock, you can see. But it came down because of the market. Market crashed, so stock also crashed. We could not see volume in the put options. Am I right or not? The volume what we have seen in the call option, we are not seeing in the put option. Yes, it has raised just because of the market uh, movement. Right? You can see here from 8 rupees it went only to 12 rupees. Right? But if you, the same thing, if you see here from 21 rupees it went to 27 rupees. Are we clear? What is the role of volume? What is the importance of volume? But unfortunately, we don't have a volume study. We are working on it, but still, we will not be having any in-depth study on volume because volume is a very tedious process. We cannot arrive to a conclusion. This stock will have this much volume, or this option will have this much volume. No, every day it is like irrational numbers. We cannot do even a basic max also in volume, right? And again we require a big softwares, so that is also not possible. In a simple way you can understand, whenever the candle is fat, yes, that stock is going to move. Are we clear, sir, madam? Any doubts? So next is in volume candle, sir, there are only two things. One is green border, body color is white. Red candle, body color is red. Red means downtrend, green is uptrend. Fat candle is nothing but, just now I told you, no sir. See, whenever you see a candle becoming fat, that means the momentum is coming inside. We were speaking about, in futures, we were speaking about momentum, right? Not only in futures, in options also, we were speaking about momentum. Unless there is a momentum, what will happen? Stock will not move upside. I'll show you one more thing. Tata Motors, let's see in cash. Time is 10:52. You can see here, the whole day it was in consolidation. The whole day there was no movement at all. Right? Even we cannot make an entry exit based on the volume candle. It is the additional point of identification. The momentum is there or not. That's all. Right? Based on this, we cannot make an entry and exits. Right? So you can hold whenever you see a big candle, you can hold for higher profits. You can hold for higher profits. Especially this works in Nifty. Especially this works in Nifty. Right? So next is advantages. There is no need for stock to give big movement like 5 to 10%. Range analysis is sufficient to participate in this strategy, just 2 to 3% target. Risk is limited, reward is unlimited, timeline is known 3 to 5 days as per learning. So it should be only 3 to 5 days. Span margin is less. If the trades are accurate, we can pick a risk reward. If the trades are accurate and the risk reward is picked at the right time, we can make higher ROI. So same thing will be applicable for put ratio back spread. So now what we'll do here is, if you are expecting a downtrend, let's take TCS. I'm expecting a downtrend. So it is in between. So I'm expecting a downtrend. So what I'll do is, TCS future is 4016. I will sell 4020 put option. I will sell 4020 put option, and I will buy from here 1, 2, 3. 2 lot put option OTM. ATM I will sell. OTM I will buy 2 lot. It's a 3 leg strategy. And day 1 it is the status. If it is hitting our stop loss, that means if the stock is going up by 1.5%, the maximum loss will be 2,400. But I don't think for TCS we don't have to keep a stop loss of 1.5%. All these option strategies we can strictly follow 1% in the spot level, spot or future levels. 1% stop loss we can fix it. 1%. And anywhere if the stop loss is more than 1%, do not attempt the trade. Are we clear? That trade should be ignored. So always our loss is less than 2,000 rupees. Always our loss is less than 2,000 rupees. Now if the stock is going down as per my desired direction, I make exponential profits. That too, I am knocking off 3 days theta decay. Is that good, sir, madam? Now, do you have any fear in trading in options? The only parameter is, instead of spending 22,000 rupees, you have to spend. See, at least what we'll do when you want to buy a TCS, what you will do? You'll buy a premium of 89 rupees. Instead of spending 15,000 rupees, you have to invest double the money, but that is for your capital protection. Are we clear? Any doubts, sir, madam? Any questions? Always buy. Okay, here I have done some mistake. Okay. Always buy first and sell next. Then only we'll get the margin benefit. See here. When you sell the option first, you require 1,12,000 rupees, which is not at all required. So always buy 2 lot option first. Then immediately within 1 minute, you have to sell one call option. So it becomes 31,000 rupees is the final margin. It is not individual legs. These two should be triggered in one instance. This should be triggered in one instance. Everything should be done within 1 minute. And again, exit also should be done within 1 minute. Don't exit one position